Hey, let's just start with a really quick 5-minute life insurance lesson. Let's say your estate planning attorney told you that you needed $1 million of life insurance coverage, and you get to choose to pay somewhere between a minimum premium and the maximum premium. So, who determines what the minimum premium is? And the answer to that is the life insurance company. Their actuaries, their bean counters calculate the lowest amount that they can collect to pay a profit to the company and cover the payout for the 2% who will still have their policy in force when they die. So, who determines what the maximum premium is? And this might be surprising because the answer is the IRS. So, why does the IRS care about how much money you put into a life insurance policy? And the reason is it must be bad for them and good for you. And number two is it must have something to do with income taxes. Now, back in the 80s, wealthy individuals were dumping loads of money into whole life policies. Insurance companies were taking out full paid ads promising tax-free retirement. Well, the Treasury Department also noticed these ads and decided that they needed to do something about it. So the IRS rewrote the rules to put a cap on how much you could put into an insurance policy. These rules are called TAMRA, DEFRA, and TEFRA. And this put the limitations. Now, that was after the creation of what they call qualified plans that turned you into their money manager and guaranteed steady and increasing taxes for them. That's an IRA, that's 401k, 403b, SEP, those type of qualified plans. Now, did you realize that these plans were designed to help the IRS increase their revenue? Now, see, let's say that the minimum insurance policy premium for the $1 million on a term is $1,274. So the maximum premium is $74,421. Now, if it came down to your family, who is going to be writing the check for $1,274? Which would you choose? And my wife would suggest I take the $1,274, which is the logical answer. So my question is, who is putting forth $76,421 in for $1 million worth of life insurance? And really more important is, why are they doing that? And here's the answer. They're people just like you, and there are 9 great reasons why. So first thing, tax-free death benefit. If you buy term, you only get this if it happens that the policy is in force the day you die. And term gets very, very expensive as you get older, and that's why most of these policies fall off the books as people age, and thus they don't pay out. But the number 2 benefit is tax-free accumulation. You're not paying income tax on the growth, much like you have in your qualified plans. Number 3, tax-free withdrawal and distribution before you die. You're not getting that in your qualified plan. Amazing tax-free treatment if you do it properly. And number 4, it's available prior to 59 and a half without the 10% penalty, which is awesome. You don't have that in your qualified plans. And then number 5, it can be used as collateral for a loan. If you're trying to buy a business, if you're trying to buy a house, if you're trying to you can use it for collateral in so many different ways. And then number 6, in most states, you get creditor protection. If there's a lawsuit or something against you or your family, this is not assets that are available for the other side for judgments to be attached to. So it's a really nice way to take money off the radar for judgments and whatnot, and it also takes money off of the IRS's tax radar as well. So number 7, it is a competitive rate of return, and as this unbroken growth compounding curve heads up, man, it is amazing. And you would be surprised if you really knew what was going on in the stock market after taxes and what really happens with the losses, where your net ends up on your stock market investments. But you'll find that insurance is a competitive rate of return. This is why the wealthy and the smart people are using this asset class as cash storage. Self-completing in the event of a disability. This, you can choose to add a rider on your policy that if you become disabled, you no longer have to make your premium payments. It's just taken care of for you for the rest of your life. And then number 9, nearly unlimited contributions. As you can see, someone can put $76,000 a year in there. Try to do that in a in a SEP or an IRA or a even a Roth. Man, it feels like even right now, almost everyone I know makes too much money to even use a Roth IRA. It's a really nice structure, but it's not any good if you can't use it. So the money you can put into a policy is based on your net worth and your income and your age and your death benefit, but we can structure these things to, again, accept big contributions. Our organization has already taken over $4.5 billion of our family's money off of the IRS tax radar. So really the question is, how much of your money do you want left on the IRS tax radar? Let's talk about it.